Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah, and the Talking Point today are the views of Harish Krishnan of Kotak AMC. Um, I, I've followed him on social media for some time now. He thinks deep, and it'd be lovely to understand from him how he thinks about the aspect of money making in a scenario wherein growth is not that promising, but themes within could be strong even in a flattish growth scenario, if you will. I don't know if he subscribed to that flat growth theory or no, but yesterday he was responding to somebody on LinkedIn, and I thought I'll pick up that thread to kickstart our conversation. Harish, good having you as always. Thanks for taking the time out. I saw you respond to a common friend's LinkedIn post yesterday about growth numbers and how they're flatlined for the past few years and not just the last one or two, and whether, therefore, the exuberance in the market, and I'm calling the recent move a bit of an optimistic or an exuberant move, is that warranted? What are your thoughts here?
So, thank you, Neeraj, for having me. It's indeed a privilege for me to come on your show. So, from a I wouldn't. I mean, I'm definitely not in the camp that that one needs to get carried away by the fact that we are at the cusp of something meaningful, transformational, and all the other adjectives that many people give about India and Indian markets. But neither am I in a camp that it's all doom and gloom. I think one needs to be realistic in the sense that it is as you rightly pointed out, it is a muddle through growth as far as global growth is concerned. Our own growth needs to be contextualized in the scenario of the muddle through growth that we've seen in the last 10 years. And over there, yes, there have been some positives, there have been some negatives, but by and large, if I were to look at it, I think while the growth aspect has kind of come off in the last 5-7 years, what to my mind is also more important to focus on is whether the growth is coming from productivity gains or is it coming from other aspects. And over there, I think India really stands out as an outlier in terms of the productivity gains that we've seen over the course of the last 5-7 years. And to me, therefore, it suggests more the longevity of the growth cycle. It may still be a shallower growth cycle compared to what we, should possibly, which is our potential growth. But can it be a lot longer growth cycle? I think that is what the productivity gains led growth in terms of reforms, be it in terms of our digital stack, be it in terms of the various initiatives and supply side measures that have been taken. All of them point out that while the growth might be lower, but it might possibly last a lot longer. And I think in an environment which is fragile, I think the stability aspect actually scores quite well. With respect to markets being exuberant or otherwise, I think the froth that we witnessed, say about a couple of years ago, is kind of damped down quite meaningfully. And so, if we were to look at a simple yardstick of say our GDP share, for example, as a percentage of the world economy is close to about 3.3, 3.4%, and our market cap share is about 3.1%. So it doesn't really point out to something very stark out there.
Sure.
But yes, within that, of course, there are some pockets which are overvalued, some pockets which are undervalued, etc. But I think it is important to keep the bigger picture in context that it's going to be a shallower growth, but hopefully a longer growth cycle this time around.
Harish, the skeptic would argue that aside of the macros, which is that the geopolitical conflict is still on, we are not still out of the woods when it comes to global growth. If anything, we are moving into a scenario wherein global growth will be anemic to very, very weak over the next 6 to 9 odd months at the very least. And if Indian earnings growth doesn't match up to the lofty 17-18% expectations for FY24, but if it comes at about 12%, hypothetically, which some brokers believe it could, or some analysts believe it could, then we are looking at a valuation multiple which is not just slightly above standard deviation, but significantly above the mean and one standard deviation as well. And therefore, there is a cause to be a bit cautious at the current levels. Maybe at 16,800, things were meaningfully in favor of a bull from a tactical perspective. At 18,300, it is not so. What are your thoughts on that?
So I think there is a bout of reality in that cynicism. I do subscribe to the view that as an aggregate, earnings are going to be lower than the 17-18% that many people kind of pencil in. And while from a Nifty point of view, the heavy lifting was clearly being done by banks, which have had a blowout kind of an earnings. The rest of the pack has seen meaningful downgrade. So I don't think we can wish away from the fact from that. Having said that, I think one has to also nuance as to where the pockets of growth are going to come from. So if I were to take you back over the last 2-3 years, what had happened in India was primarily that WPI minus CPI, was at its record low over the last 20 years. What that had meant was that the manufacturers or the intermediaries or the companies were facing a far higher inflation compared to what they were able to pass it on. Now, this impacted earnings of few companies negatively and few companies positively. So if you look at the ones that got impacted positively, were the likes of the commodity plays, which went through a significant kind of an up move, right? For example, in a large diversified conglomerate, we had, for example, a steel company making more money or more profits than the software company at a point in cycle, right? Now, what obviously, markets did anticipate that these were cyclically high earnings and they will kind of recoil back, which to a fair extent it has already happened. And therefore, Ps were much lower at that point of time for that set of earnings that did bounce back. However, if you look at which were the ones that got impacted negatively, where the likes of, say, the auto sector, the consumer discretionary, to a certain extent, even the manufacturing or the investment-led intermediaries and the processors that couldn't really pass on the pricing that they had in terms of basic commodity price increases, etc. Now we are starting to see the reverse happen. So if one were to look at wearing a slightly more nuanced view, I think the fact is that markets will kind of want the better quote unquote quality. Of course, it is a subjective thing, but the more longevity, the better cash flow conversion kind of places, including, say, consumer, auto, even on the core manufacturing side, etc. That will invariably tend to trade at a higher multiple compared to the plain vanilla converter stroke commodity companies. And therefore, it is in that context that I guess one will have to look at valuations rather than looking at it purely from a statistical point and proffering that now maybe valuations are slightly more higher. But I do concede that there is going to be an earnings slowdown or the growth. Rather, I think there is going to be a shave off of at least a few percentage points from the numbers that you did mention, and therefore my base case is I think it's going to be a range bound market. You're going to see bouts of these up and down moves. We've seen the last 18 months of essentially markets being in a tight range. And I would think that especially in the run up to the elections, markets will continue to do the same. And possibly 3-4 months before the elections is when markets will come to its own perceived wisdom of where they think the political regime, etc., is going to be. And then I guess that is when the next move is likely to come through. That, of course, is the base view. Of course, markets have a way of humbling everyone, and this is no exception.
Okay, just before we move on to specifics, just a follow-up to the answer that you gave. Why is it that companies, you reckon, now have the ability to pass on the higher input costs? Is it because consumers are now able to shell out more for the goods? And part two of that question, what you're recommending, in fact, if I understood you correctly, is that high quality will take precedence, which means the market, contrary to what a lot of people are saying, will actually become broader, might actually stay narrow or become narrower, Harish, according to you?
So I am in the second camp that it is going to be a bit more narrower, in the sense that generally, value or as a style does well when there has been generally a lot more earnings surprises across the board, or when there is the momentum of earnings across the length and breadth of the economy. And we did see that, post the lockdown, wherein the spurt of consumption unleashing out after, being coiled back for, say, 6 months to 12 months, depending on various sectors, really came out very strongly. And that kind of pushed and gave a tailwind, along with the fact that there was the shift from unorganized to organized, etc., which meant that there was a whole broad-based participation that we saw through. Of course, over the last 18 months, that broad-based participation has kind of narrowed, but I would think that it is going to get slightly more narrower in the times to come before, like I said, the market comes out with a broader trend in terms of how it is likely to think about political regimes in 2024, and therefore its impact on overall investment and overall consumption, etc., to take it from there. So yes, that reading of yours is what, at least in my base view, is as well.
Okay. Now I want to try and probe you a little on some of the themes, because if the market is going to be range bound, I guess it's individual pockets which will give the alpha in portfolios. I want to talk about some of the hard to guesstimate, slightly longer term themes, Harish, if you will. And I've noted it down. I want to start off with electrification. There's a panel yesterday which recommended that diesel vehicles be banned by 2027 in big cities from 2024. Let there only be electric vehicle permits given in big cities. And there is a whole ecosystem getting developed out there. Maybe two-wheelers are first of the block, but four-wheelers getting into the fray as well. How investable is this in the current context as we stand? Sure, there'll be more players that will come in as times go by. But if you want to be an early mover, how investable is this theme, and how are you thinking about investing in this theme?
Sure. So obviously these are longer term trends, and therefore from the context of whether they are going to play out in the 8-9 months ahead, clearly there is nothing that can possibly work. If it works through, it is pure luck, nothing else beyond that. So, if you'll allow me a minute to kind of lay the broader canvas of energy consumption, and then I'll come to electrification in the context of transportation, right? So, if I were to look at the last 22 odd years that, when we look at data, obviously we've grown our GDP. Our energy intensity has actually started coming off, and that's primarily a function of the fact that our services are growing faster, etc., etc. But even within that broader canvas of energy, if you were to look at how within that, broadly two pieces of energy, one is say electricity, and second is in terms of, say, petroleum based products, right? Now, if I were to look at petroleum based products, and if I look at only crude, 35% of energy, used to come from crude in the 2000s, and that has come down to 30%. Now, a 5% fall may not seem to be much, but when we are talking about these long-term trends, it actually means a significant amount, as I will bring out when I look at the overall data that's coming through. More importantly, you're actually starting to see electricity or electrification of energy of our overall consumption, be it in residential, industrial, or transportation, as you pointed out, starting to happen in a meaningful way. Now, if you look at our taxation of how it is structured, and it's got nothing to do with this regime or that regime, by and large, what we have is that given the fact that we have very little energy, domestic sources of petroleum, so to speak, they are taxed significantly higher than electricity when it comes to the consumer. So if you look at the total consumer outgo in between these two broad pockets, so let me say petroleum based and in terms of electricity based. So when we did the numbers in 2021, before that big spike in crude, etc., in terms of electricity, the total consumer, including losses and subsidies, etc., that were being paid is close to about 7 lakh crores. And on the petroleum side, it's about 11 lakh crores. So keep in mind that petroleum and gas and all that is only about 35% of energy. That accounts for almost 65% of total outgo. So what I would concede is that over the course of the next 5-10 years, we are going to become larger as an economy, but our energy intensity is going to keep coming down, notwithstanding the vagaries of the prices of natural gas and petroleum as well as coal, etc. So, given this context, I would think that electricity is going to become, maybe in the next 4 5 years, or maybe even sooner, the larger part of the outgo from a consumer point of view. So that's the first key point, right? Now, within this, if you were to look at where electricity is being used, you've got obviously the residential part, and of course, given the significant acceleration in terms of electrification, etc., that we are seeing, and the fact that there still is a lot of load shedding, etc. The reality is, I think the residential side, the growth can be quite large, and we are already starting to witness that. Industrial, if you were to look at it, and this was at least a startling data point when I saw it, close to 50% of total industrial power that is coming or that is being used by industries across India is now coming through captive power or regenerative power. And this is actually a very big differentiator as far as India is concerned compared to the rest of the world, where most of the rest of the world is very happy to take on with grid power because they know that it is reliable, it is at 24 by 7, etc., etc. Whereas in India, because of the very high tariffs that or the subsidization that industry had to pay for agriculture and to a certain extent residential, it meant that there was a reasonable incentive for industries to actually put up captive or regenerative power. And therefore, we are talking about almost 50% of total industrial consumption now being made good by regenerative or captive power. So, given this broader canvas, now coming to electrification and the associated opportunities that's there. Now, obviously, I think we are going through this transition that wherein we want to reduce our dependence on crude, and as well as for the emission factors that we all know about, that we are embarking on this journey. Now, while the end state many people believe could be electrification, there is also an interesting thesis that's coming through that it could be hydrogen based end state to a reasonable amount that can come through. Now, obviously, it's a chicken and egg situation in the sense that while we all know the end state, we know that the last mile distribution is where the hurdles come through, which is basically that if you're stranded in a highway and you don't have access to energy, then you basically are
Yeah.
unlikely to consider that when you look through. So clearly, therefore, it does point out that within a city commute is what is likely to be moved more into various other alternate forms of energy. It could be electric, as we are starting to see in two-wheelers, or it could be even in the form of, say, auto rickshaws, or maybe even intra-city buses that will go into the route of electrification. But given the fact that India is actually a significant head start in terms of the hydrogen economy, in the fact that we already consume about 6 to 7% of the world hydrogen compared to many other sources of energy, and that's primarily because of a very large refinery that has hydrogen as one of its output, and therefore there is a case for India to move into hydrogen in a meaningful way. Now, the way we look at it is, there is obviously generation of various energy, then there is transmission, there is distribution, and say the last mile factor, and then you've got the players on the OE side, on the ancillary side, which can all make it into a vibrant ecosystem. Now, if you look at each of these players, my considered view is that if there is no differentiation, returns go to the cost of capital. So, if I were to look at generation today, be it on renewable where there is a lot of excitement, I somehow think that there is no differentiation between company A and company B. Their cost of capital, most of them have access to European cost of capital. In terms of, say, if you were to look at land, again it's all mostly on lease. If you look at, say, on the solar side, most of them are trading in from China, though there is now going to start coming through in terms of the local production, but still some time away. And therefore, when everything is going to be similar similar to anybody else, regardless of how much ever demand comes through, I don't necessarily see value getting captured for the end shareholders over a cycle. Of course, there will be points in time wherein it can be very exciting, but by and large, I would say that's not going to happen in terms of a longer term value capture, in my view. Similarly, if I look at transmission, I would say that it is by and large a state monopoly with few utilities out there. But where I would think a reasonably large value capture is going to happen, and where there is need and there is a pain point, is on distribution. And there, I would think that the last mile access. So it could be in the form of, say, gas utilities, or it could even be the oil and marketing companies who may have got actually the last mile access points ready. Now it's a question of when they convert it, how they convert it, and the cost of converting a lot of these stations into hydrogen or into electric points. But I think we are starting to see that happen, and there I would think things are still very cheap, and therefore I would think that that is an opportunity from a slightly longer term point of view. But I would think that the biggest opportunity lies in the ancillaries and the technology companies which actually have technology to either convert it into hydrogen or to move and transition into electric. And over there, we have a few auto ancillaries, over there, or even in terms of industrial goods that can do that. So I would say that those are the two broad pockets that we think from a slightly longer term can capture this value of this great transition that we are seeing. Not to say that the other places can't see value creation, but like I said, if there is no differentiation, I think over a long period of time, returns to shareholders will become the cost of capital for these industries, which is not really something that we, here at Kotak, particularly fancy.
Okay. Now we are almost out of time, Harish, but I want to quickly squeeze in maybe a 60-second answer if I can. And I wanted to talk about 3-4 themes with you. Unfortunately, we don't have the time, but I do want to check with you in a slightly shorter fashion as to why you constructive IT. I'm moving tracks completely, but it's an important one considering that the results haven't been great. Considering that a lot of people are saying that even the second half recovery is a bit sketchy. So why are you penciling your hopes there? Quick 60 seconds if you can.
Okay. So it's tough to do it in 60
Sorry, but yeah,
give me 2
just
minutes.
paucity of time.
Okay. So very quickly, see the fact that it has been 18 months into a advertisement of the macro recession. I think everybody knows that there is a recession. Is going to be a slowdown, be it in one edge and possibly even in two edge. So that I don't think there is any doubt. Of course, the severity of that, only when numbers come out, we'll know how bad things really are. The key aspect to look at is how FY25 comes through. And now, of course, one can say is that if people don't have visibility of FY24, how is it that you have any visibility of FY25? But which is where you look at longer term trends, right? And you try and get parallels out there. So if you look at, say, for example, Europe, which was in the storm, last year, and you look at even this quarter wherein results were generally weak, Europe has actually been extremely strong for most of the companies. So the point really is that this is companies want to go into this kind of spending. It is that they are buffeted by all of these uncertainty, and therefore they want to hold back for some time. And therefore, as and when that eases off, you're going to see a bounce back. So that's point number one. The second point that we look at to get some comfort is more in terms of what we look at profit pool shares. So if you look at profit pool shares of the IT sector, it's been a growing sector. And when I say profit pool share, what I mean is profit pool of IT sector divided by the top 1,000 profitable companies which are listed in India. So just very quickly, in the dot-com bubble, it was 5%. That went on to about 7-8% at GFC. And then from there, it went on to about 12-13% of total profits pre-COVID. During COVID, it went to about 15%. And today we are at 9%. So the call really that one is wanting to take is that in 3 years, can this 9% go back to 12-13%, which was there pre-COVID, or is it likely to go to, say, 7-8%, or is it going to stagnate at 9%? And while there is clearly a downside in terms of earnings, etc., that come through in this first half and possibly in the second half also, as you rightly pointed out, I think the call, if one has a 3-year view, would be that 9% go to 12%. And to that, I would think that there is a good chance of that happening. Now, the key question is, have valuations come down to a level wherein we can throw in all the towel on macro uncertainties and go blindly ahead? Unfortunately, that is where the issue is, that valuations still are quite anchored to what happened during COVID, and therefore there still needs to be some softness. But to blindly believe that, recession, etc., is where I would think that the street might miss the bigger picture, which is that these are extremely well managed companies, cash throwing companies, with a good cash yields, etc. And therefore, we are currently neutral in most of our portfolios. We're not overweight. But the thinking is that in case we get a meaningful correction and valuation compression, we will go overweight on the space.
Thanks for that balanced view, and really helps think about both sides of the coin, Harish. And much appreciate the whole explanation around this whole energy piece that you gave us today on Talking Point. That's the cornerstone of my takeaways from this interview. Thanks so much for that, and thanks for sparing the time today.
Thank you so much.
The pleasure was ours, and viewers, thanks for tuning into this edition of the Talking Point.